Hey everyone, welcome to the KE Report. In this daily editorial, we're going to be recapping US economic data from this week, Jerome Powell's comments that really moved markets at the tail end of the week, and look ahead to what is going to be a bit of a slower week next week for any potential market moving data. I am chatting with Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark II Market website. Click that link in the show notes to visit Marc's website. Marc, just a quick recap of this week's data. We had inflation data out of the US, CPI and PPI. We also had retail sales. Those were more the headline, bigger data points. None of them really surprised markets. Retail sales came in a little under estimates, but past month was revised higher. Inflation data still right around estimates, but we have definitely seen a stop in the decline in inflation. It seems to be more or less flatlining with maybe a little upward bias from here. Marc, break down what mattered to you in your eyes for the data this week out of the US.
Yeah, sure, Corey. This week, I think, really has been still dominated by positioning and post-positioning of the since the U.S. election. But the U.S. economic data was important. The CPI is probably the single most important U.S. economic release, and we did see that come in a little bit firmer. That is to say that for the first time in many months, headline CPI rose from 2.4% to 2.6%. The underlying core rate was steady at 3.3%. I think the takeaway from this really, though, is that one, we should expect still an uptick in the PCE deflator, but more importantly, that the market is still like straddling the fence about a December Fed rate cut. My sense is that it influenced the market more than it influenced Fed officials. We had retail sales and industrial production at the end of the week, and we had, like you mentioned, retail sales, even though the headline itself up 0.4, the underlying weakness you point to was really when you exclude autos. We already knew that auto sales were stronger, but when you exclude auto sales, it was only up 0.1%. And then the control group, which is what economists use to calculate GDP, and they take some components of retail sales. And those components that they take of retail sales was actually down 0.1%. And the market was looking for up 0.3%, so it was very disappointing. But as you mentioned, the back month, that would be September, Q3 data was revised higher. So we stuck with this idea that the US consumer, still very strong in Q3, began Q4 on a slightly softer note. And that sort of matches what we saw with that industrial production figure, too. Industrial production fell for the second month in a row. We know we lost manufacturing jobs this year. Manufacturing output was also sluggish. It lost 0.5%. And this is after a 0.3% decline in September. So we are seeing signs that even though the U.S. economy grew well in Q3, it ended on a soft note as far as the industrial sector goes, and it's begun off on a softer note for Q4 in terms of consumption.
Marc, when it comes to inflation, look, a lot of people are saying inflation is going to be sticky above the Fed's 2% goal. It's slightly above that right now, but we definitely have seen a bit of a turn in direction with the slight increase in some of the inflation data. There's also people out there that are saying inflation could go back to 4, 5%. What's going to drive this from here, Marc? And what is your outlook for inflation in terms of the balance between potentially spiking higher, grinding higher, or staying flatlined above 2%?
Yeah, I think that this is, I think, the key issue right now for the markets. Not sure that inflation is really on its way. They don't have the confidence, I should say, that Fed officials have suggested they were about inflation reaching its target. It really depends. I think that partly it's the time frame, and also I think of what Powell said at the press conference after the FOMC meeting. He said that he said three key points. One is that the Federal Reserve is committed to reducing restriction, which means over time bringing the Fed funds rate towards neutral level. It's not clear exactly where neutral is. I think many people suspect it's at least 100 basis points lower than it currently is. Secondly, besides the Fed is moving towards neutrality, and that that the decline in inflation, we should expect it to be bumpy, that there's all kinds of different time distortions with the housing market, other things that just make for a bumpy landing. So Powell, I think, said that the ride to the inflation target is going to be bumpy. It's going to take more than a couple of months of, of upticks to really persuade it otherwise. That's really what happened. We saw, right, in earlier this year. Very confident about inflation falling in Q4 of last year. We begin off this year with a bit of a bounce. People get really excited about it. But that's sort of, at the end of the day, I really wonder if inflation really was a large part of it was indeed transitory, having to do with those supply chains, having a little bit to do with the U.S. Fiscal expansion, which is why the U.S. inflation is still above 2%, and good parts of Europe are below 2%. And the third thing I think Powell said that's important is that, and this is, I think, the hardest thing for the market to get their head around. I know it's hard for me as well. That is the Federal Reserve under Powell's leadership, he sort of maneuvered the Fed to cut rates 50 basis points in September to start the easing cycle. Remember, one governor even dissented over the 50 basis point move. Remember how it played out? It looked like there was a story planted in the newspapers, opening up the door to a 50 basis point cut during a quiet period before the FOMC meeting. And so now Powell says, the economy still is pretty resilient. We don't think we have a sense of urgency. We're in no hurry. After beginning a cycle with 50 basis point cut and then saying you're in no hurry, it's a bit confusing. I think this is partly why the market downgraded the chances of a December cut. But even now, after the data, after the CPI, the PPI, after retail sales, industrial production, the market is still pricing in about a 60% chance of a December rate cut.
Yeah, that inflation data, a lot of people now pointing to the tariffs that Trump might impose as being inflationary. We'll need to see because right now inflation has definitely stopped going down. Some metrics, it's starting to rise again. We're not having that in spike that we had a few years ago. So it's a big question mark out there as to where inflation goes, but it seems like it's going to be tough to get back under that 2% level. Let's talk more about Powell's comments and more the market reaction because at the end of the week, the market was trending sideways for most of the week, and then boy, oh boy, it's getting hit. As we're talking later in the day on Friday, the S&P is down another about 1.5%. The Nasdaq is down over 2%. Small caps, Russell 2000 is down about 1.5%. This is all happening because, well, I guess Powell drove home the fact that they're not in a rush, as you said, to cut rates again. Is the market overreacting to this news, Mark, or quite frankly, was the market just overheated to begin with?
Yes, I think Powell's comments on Thursday did say, the short end of the U.S. yield curve, the interest rates rise. The 2-year came right back off today on Friday. So the market, I put it like this, the market exaggerated Powell's comments on Thursday and then corrected itself on Friday. The U.S. 2-year sort of stuck just below 440. We got to about 437 this week, and we're sort of at the lower end now as we go into the weekend. We're just above 428. I think that that there's a reasonable chance that we've seen the high in the near term of the 2-year, and I think we go down. Maybe it's a 418, maybe it's a 420 or so, but then we need to consolidate here. Think about how far we've gone. That in late September, so as we began getting into that run up to the election, but this is still about the Fed, about the Fed's 50 basis point cut, what they're going to do going forward. In the end of September, the 2-year yield bottomed around 350. And as I mentioned, we got to almost 340 this week, 440 this week, almost a 90 basis point increase in the 2-year yield. So the stock market has really weathered this pretty well until the last couple of days. And here I think it's a question primarily of profit taking unwinding in an exuberant market in the first place. But as this is a significant decline here ahead of the weekend. The Nasdaq's down over 2%. The S&P is down over 1%. We gapped lower today on both the Nasdaq and the S&P, and this just sets us up, I think, for a further pullback next week.
Mark, what about the US dollar? That has been on an absolute tear ever since we turned the calendar into October. The dollar entered the month right around 100 on the dollar index. We're now over 106. The dollar's been almost straight up for, let's say, a month and a half. How much higher could the dollar go?
Yeah, I think this is amazing. A 7 week rally in the dollar index. We toyed with the 107 area this week, but we still haven't. We're like just shy of last year's high. Last year's high was in late September, and that was around 107.35. But the big one, the cyclical high for the dollar index in 2022 was closer to 115. Seems like such a long time ago. Many of us forget about where it was, 115, which is why I still would think that in the big picture, that probably was a cyclical high. And even if we get a little bit closer, I'm thinking that maybe we're on our way back towards 110. But I think that cyclical high at 115, it's 114.80 late in September 2022. Remember what was going on then? The UK was having that trust crisis, big gilt crisis, and the euro is trading below parity. So I don't think we have to go back there, but I think that you're right. The dollar index has gone straight up. We've pulled back a little bit today, but we haven't taken out any kind of technical levels. I haven't given any sign that this move is exhausted. So I think that on balance, we have to look for a continuation of these moves.
Wow. It's due for a cooling off period, though, but it has been a strong uptrend. That being said, it's more or less right back to the levels that we saw in April, too. So, not even necessarily at a high for this move, although it did briefly break above those highs from April. What's this dollar strength predicated on, though, Mark? The Fed is cutting rates. I realize other central banks are cutting rates. US economic data has been generally good, but it's not screaming by any chance that it's the strongest economy out there. I guess comparing it to some of the other economies, maybe it is. So, is it US data that's driving this? Is it the new election results? Is it more weakness abroad? What is driving this move?
Yeah, I think all those things. I mean, I think that the U.S. economy is clearly outperforming. The reason it's outperforming, I think, has a lot to do with the deficit, the large deficit. And I think that the U.S. consumer and the real wages in the U.S. are still attractive. That is to say, wages are rising faster than inflation, and we've still seen the U.S. consumer, and you saw even with these retail sales today. When you make these allowances for the increase in auto sales, the U.S. consumer still looks, despite the problems, despite the delinquency, credit cards, despite the reduction in consumer credit extension, still see have the U.S. consumer fairly strong. And so I do think those are like the U.S. economy is outperforming, but I think that other countries, I mean, think what's happening just at that moment in time where Europe would seem to need strong leadership, given what's happened in the U.S., that the German government has collapsed. They're going to have elections early next year. The French government's weak. They can't even put together a budget for next year. Japan, for the first time, Japan has a minority government. And so I think that the U.S. Uh, looks, no one can keep up with the backing up of U.S. interest rates. I was mentioning to you off mic that the U.S. 2 year premium over Canada is the widest it's been since 1997, which means one is paid to be long dollars over Canada by the most in something like, what is that, 27 years? The U.S. 2 year premium over Germany is at a new wide for the year, over 200 basis points. Back in late September, it was about 135 basis points. So I think that there's also something to be said about trends, how powerful these trends are, and how do people make money in the capital markets. I think trend followers are a big basic strategy. Put this in perspective for you. Sterling is down 7 weeks in a row. That matches the longest losing streak of sterling since 1980. We've got many of the currency pairs are down 6 or 7 days in a row here, and that's how we're going to begin next week. Dollar is still in a powerful uptrend. I agree with you. The market's getting excessive here, but I think that there's no real fear of intervention. There's nothing that's stopping this. And I think it was Vladimir Lenin said something like, when you feel mush, push, feel steel, retreat. And I think for trend followers, momentum traders, the dollar express has still been the cash register.
Yeah, some of these are extreme moves, as you've said, though. So maybe a cooling off, but hey, there definitely is an uptrend. It's a month and a half long. There's also an uptrend in yields. That has followed, in a way, the dollar as well. Again, all on the back of when the Fed started to cut rates. Very contradictory from what you would project. But look, yields still aren't anywhere at highs for the year. At least I'm looking at the 10-year here, but we're back right around 4.5%. How much higher could yields go? And why is the bond market going against what the Fed's telling us?
Well, I think that I look at the U.S. bond yield and I try to understand why has it risen so much. So I think we have to like decompose it. Part of it, so I would say roughly 90 basis point backing up at the 10-year. I'd say about 25 of the basis points just reflects the break even, higher inflation expectations. You can see this on the 10-year break even. And the break even is just really the difference between the yield of the inflation protected security, 10-year tip, and the conventional 10-year yield. And that's sort of where the inflation expectation would be the difference between the two yields. But in addition to so we've got the inflation component, and then there's been a backing up of expectations of how aggressive the Fed's going to be next year. For a good part of this cycle, the market has been more dovish than the Fed. But right now, the market's more hawkish than the Fed. That is to say, the Federal Reserve in the September dot plot had 50 basis points for this year after the 50 basis point cut, and they had 100 basis points next year. So given the recent cut, that gives us 125 basis points, and the market's only pricing in right now about 75. And so that adjustment also is the adjustment on the overnight expectation is also a factor that could be a weight on the 10-year yield. In addition, you have some kind of risk premium for supply, thinking that the next president is going to basically be cutting taxes more than cutting spending, and that's going to produce a greater deficit. More debt means greater supply of treasuries, all else being equal, higher yields, lower price. And then there's also maybe another factor here, and I don't know how to quantify it, but here's what it looks like to me. Moody's has the U.S. as a AAA credit. It's the only one of only one of the big three rating agencies that have the U.S. as a AAA credit still, but it's got a negative credit watch. So I suspect that part of the weight on Treasury, it could be a small part, 10, 15 basis points, say for sake of an argument, might be on anticipation of the third rating agency go away the U.S. AAA rating, and that would be probably a 2025 event.
Interesting. All right. Well, I guess things for us to watch for, but you are right. It's interesting to see the market more hawkish than the Fed when through the last year or two, at least it's been leaning on the more dovish side. What can we look forward to here, Mark, in the next couple weeks then that could be market moving or shift any of these, I guess, new short-term directions that are about a month and a half long?
There's a couple of things that occur to me. One is we're still looking at Trump's new appointments. There's a few key ones that are still left to be announced, including Treasury Secretary, Commerce Secretary, and Trade Representative. So one would be still playing out the election consequences in the U.S. Secondly, I think that we'll begin getting as November winds down, we get into December, we'll get the next batch of data. That'll be the jobs data and the inflation data before the Fed meets again in December. We also get next week, we'll have Canada and the UK with their CPI. And those are going to be important numbers, partly for Canada, more so than the UK. So at stake in Canada is whether the Bank of Canada cuts rates another 50 basis points when they meet in December. I suspect that a firm inflation number will dampen that speculation. In the UK, the market has just about done away with speculation of a December rate cut. But a lower inflation number seems unlikely in the UK. But if we do get a soft inflation number, we could still spur speculation, bring forward the next rate cut into the first part of Q1. Also next week, we're going to have the flash preliminary November PMI. Typically, I'd say that Australia, Japan, preliminary PMIs don't move the market. In the US, we tend to give more weight to the ISM. And that leaves Europe then, where sometimes the ECB has even mentioned the results of the PMI surveys. Now, those are the highlights for next week, but I think the broader context is still about what's going on in the US. appointments, nominations, as well as the trajectory of Fed policy.
Yeah, policy and, well, what Trump is going to do. But hey, we are still in that time period where we're all waiting for him to take office to see what actually comes to fruition. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Click that link in the show notes to follow along with what Mark is writing on pretty much a daily basis. Mark, as always, thanks for your time today.